Welcome back to PetroNerds, the podcast, episode 19. I'm here with Trisha Jean Curtis, the CEO of PetroNerds. I'm Ethan Bellamy. I'm a principal at BP Capital. We're here to talk about energy. And specifically today, we're going to dive into the second part of our long conversation because Trisha is never short on volume or quantity when it comes to energy policy. So today, we're going to talk about presidential executive orders. There are two that are worth discussion. And the activist takeover partial takeover of the Exxon board by Engine No.1. And then we'll also conclude with some discussion of Dakota Access pipeline. So
Awesome
with that,
topics.
Let's kick it out. And before I let Trisha start freewheeling here, I should disclose that BP Capital does own a position in, we are long ExxonMobil.
And I'll actually go, I actually have I think we said this in a previous podcast. I'm long Exxon from, I think I bought it in I bought it in 2014. But anyway, so we're recapping from, we did talk, there's so much happened in the last couple weeks. So, and I was in DC last week, and so Ethan and I weren't together. So we just had a lot to talk about, and it's very, very timely. So in the previous podcast and with the one that we just recorded, which will be last week if you're listening to this, we talked about natural gas. We talked about OPEC, oil prices, Saudi Arabia, inflation. So we kind of covered the gauntlet there. And now we're going to get into the really fun stuff, which is all the stuff which people are calling like black, basically they're saying the oil industry has been decimated last week because on Wednesday, three major things happened. And that was that Exxon had lost 2 board seats to this activist investor group, Engine No.1. Now we've confirmed that they've lost actually 3 board seats. And then Shell was a defeat against Shell in a Dutch court, basically said they had to significantly reduce their emissions, which would, if they actually complied with it, they would actually have to reduce output by percentage points. I mean, they would actually have to reduce natural gas and crude oil output of their company.
I think it's easier for them to just move to Lagos.
They're appealing it, obviously. So that one's kind of interesting. And then Chevron also was dealt a blow, which is interesting because, Chevron has seemed to be performing better, especially than Exxon. And Chevron was dealt a blow, and that they have to actually, their shareholders said they have to decrease emissions as well. And it's the end user emissions, which is basically scope 3, which I think is really tricky and not actually plausible, but we will get into that. And then obviously Dakota Access. So this executive order, so there were 2 executive orders that happened last week, and they follow in actually nicely with this Exxon discussion. But I want to start out with this. More Drilling actually just sent me a text.
For those uninitiated, More Drilling is the anonymous username of a very smart petroleum engineer, reservoir engineer on Energy Finance Twitter, yes, who is worth following. He's very sharp.
Yeah, very sharp, has lots of funny memes. And he just sent me an article on this, why shaking up big oil could be Pyrrhic victory. And this is from the magazine Foreign Policy. Essentially, I think even Wall Street Journal has written, every single entity has written about it, but it's actually the New York Times had a piece this weekend on activists crashed Exxon's board, but forcing change will be hard. So the reality is that all these articles basically come to the point of saying, okay, well, you did this, you're on the board now, but so what? And I think it's so what, and like, will you actually have change? And I think it's really important to tease this out because I don't think it makes sense. I think it's counterintuitive actually to, it would make more sense for me to go on a board to push for a solar company, to be more profitable and to maybe not, be using, forced labor or something. It doesn't make sense for me that a Engine No.1, and actually there's a thought to this, different people getting on boards, but it doesn't make sense for me that an activist investor who's actually after profits is going after Exxon to get board seats with the grounding that they need to reduce their emission and that they need to reduce their emissions. And it's not even, it's all muddled together. It's not necessarily reducing their emissions. It's they're basically backing, which I have it from several months ago of their report, is on the back. The premise is that, and their logic is that oil demand is declining. Exxon's late to the party. Exxon has not admitted that they're,
Yeah. Well, let's step back and parse that part of the equation. So big picture, we oftentimes make the mistake of getting too granular. So big picture here is that if you go on to Engine No.1's website right now, there's a lot of stuff that's pretty hard to disagree with, which is Exxon has underperformed. They needed to make better capital allocation decisions. incentive alignment with better performance. Those are hard to argue with. I mean, I've said Exxon needs to earn its dividend to
Absolutely.
keep paying it, right? So, but the genesis of this isn't on what you see on their pitch on their website today. Right. The genesis of it is, hey, we think, this is Engine No.1 paraphrase, we think that oil product demand is headed down, and Exxon's acting like it's business as usual and investing accordingly, and that doesn't fly. That change in how this has been laid out is pretty interesting to me.
Yeah, and that's where it's so this is where it gets. This really needs to be teased out, because I haven't heard a whole lot of people do this justice, and I'm hoping that we will give this a little bit more justice that deserves. So so firstly, they lost 2 board seats, and people were saying, well, Darren Woods may actually lose his CEO position. Ethan and I think have been pretty honest. I don't think Exxon has performed super well during COVID. I don't think they handled I don't think their tone and their voice has been very great over the last couple of quarters. They chose to increase debt. They chose basically the increasing debt. And they massively reduced their rig count. They were really, really exposed. I mean, they had 55 rigs running in the Permian Basin when COVID hit and everything collapsed. And they have 7 rigs running now, and they have over 400 DUCs in the Permian Basin. So now they're fracking those. So, I have folks asking me and clients asking me, okay, well, what does this mean? What does it actually mean on the ground? I think they still have to hit, at least prior to these board seats, I would have said they had to hit their targets for production, but who knows what these board seats actually mean. But the reality is so they have massive debt. So all these reasons, if you are unhappy with Exxon's performance, that makes total sense. That from an activist investor standpoint, the green ESG piece does not make sense to me from an activist investor standpoint, because it was a few months ago, and I don't think this report is still on their website. I looked for it because I went through the Engine No.1 and looked at everything, and they had this big thing on Exxon. So their first report is called Energy Transformations, Technology, Policy, Capital, and the Murky Future of Oil and Gas. That's basically, this was from March 3rd. And it basically, David...
Of last year.
March 3rd of this year. So
really?
Yep.
Okay.
This is recent. So I've been following this for a little while. This report, and I've used it because they actually took all the forecasts, everybody's forecast for oil demand, and they put it together on one chart. And they basically said, this is their premise for, look, everyone is saying oil demand is going to be less, and you, Exxon, are not with the times, and therefore you're going to have stranded assets and lose a lot of money, essentially. But they really get into the energy. It's a great paper from a thought exercise standpoint of studying it. And thinking about it. So their demand logic, and this is quoting, I'm quoting this, basically they say, when concerns about oil consumption were rooted in energy security, as they were from the 1970s until recently, demand mattered less than reliable supply. And they go on about this whole thing. But they say, quote, fear of climate change transforms that mindset. No longer is the central platform adequate supply, but excess demand. Policy, in this new mindset, focuses on eliminating demand where possible and switching to alternative technologies such as electric vehicles that serve the needs provided by oil today. So the whole premise is guided in demand is declining, and you're going to be late to the party, and you're going to miss out on this. And that's a little bit tricky, because now that they've done this, now that they've gotten on the board, and by the way, so they got on the board because BlackRock and Vanguard sort of took a knee, and State Street Advisors, I think. 3 of those companies basically have pretty big ESG momentum and favors. BlackRock has basically said they're going green, and then got criticism for not doing it well enough. And so I think that they wanted to be seen like they were doing something. Same for Vanguard. And I also think, to Ethan, what you just said is that Exxon hasn't been performing well. So it kind of makes sense. Why not change this up a little? And the 2 people that were confirmed both had, I think, refinery backgrounds. They weren't complete non-oil people that are on this board. And actually,
we should point out that they had 4 candidates, 3 of which were confirmed. The 4th that wasn't confirmed is the CEO of Vestas. The first 3 are oil and gas folks. So it's not like they're, Greg Goff is on the Enbridge board, and he used to be the CEO of Endeavor. Yeah. So he's not going to go in there and advocate some pie in the sky plan.
And I'm not criticizing the board members or what they did, or the fact that maybe Exxon needed a board shakeup or anything. I'm just the premise of what Engine No.1 is trying to do. And I think we have to be the guys of the whole thing. So basically, they took a $30 million stake in a company and turned it into this, this transformational thing. And they're backed by, I know it's California pension fund, but other state pension funds as well. So I just think you have to be careful if you're putting your money into that pension fund. If that's your money, if that's my pension fund dollars, I think it's going to get a lot of talk and a lot of publicity that Engine No.1 did this. I don't necessarily think it's going to deliver them a return, because they're, the point is they want this company to become more profitable, but it's all under the premise and guise of the ESG and green focus. And I'm not certain that you can necessarily, at least it will take a very long time. And all these, including the New York Times, said the same thing. This would take a long time to actually turn around, to actually see a profit. So to me, I guess the concept, other than publicity, of doing all of this with Engine No.1 premise, they're also apparently raising money now on the back of all this publicity. They're raising money for a purely green fund. So they may have had ulterior motives with this. And
well, let me step back as an asset manager and just say,
please do.
Kudos to them. They're in every discussion.
Yep.
They're raising a ton of money.
Yep.
They were effective in jawboning big fellow investors into executing almost all their plan. They knocked it out of the park. So whatever their premise is, they've done something good. Now, whether it makes them money or not on their Exxon position, I don't know about that, but it certainly should help them raise money in the rest of their business.
And so from a business perspective, they seem to do it. I don't agree with the premise, and nor do I agree with those. I don't agree with the fundamental premise behind it. And I think it gets messy if you are an investor and you're putting your money into Engine No.1. I would want to understand it better. But Chuck Yates he said, I think on his podcast with David Ramsden Wood on Hot Take of the Day, he said that, you should invest in things that you don't actually are not in love with. And it's good advice. It means that I shouldn't be investing in, I'm passionate and understand oil and gas. I really should be investing in things I hate because I'm going to do better. But the point is that, there's a number of things. If you're doing this because you believe in the movement, that's one thing. If you're doing it because you want to make money, that's another thing. But these are pension fund backed things. So if we're thinking this is going to continue to happen, there are repercussions or ramifications for how much money these guys will actually make. And the demand, I disagree with I don't think Darren Woods has done an excellent job in how he's, taken the company through this 2020 and into 2021. And, you can hear it in his sort of tone. But obviously, I think he survived this. So he's still the CEO. People thought this might be a reckoning for him on that. I don't know how long that is. I would say that given all this volatility, I wouldn't say he's going to be there forever. But it would be hard to be an oil executive CEO and stand up there and change your tune. And I think Chevron's getting pressure for this as well, of saying they will, I think they're getting pressure to say, demand is declining and we're not, oil demand is declining and it's not going to be here for a very long time. I don't agree with the IEA forecast, nor do these CEOs agree with it. They would be lying. If these CEOs get up and tell you that oil demand is declining considerably, like it's not just peaking, but then declining dramatically, they're not telling you the truth of what they actually believe, because they don't believe it. And the CEO of Chevron has been very clear that he doesn't believe that and that he will be providing the crude oil.
Well, it is a challenge for the big multinational oil companies CEOs, because they are very much ambassadors of nation states, and they can't just say the IEA's numbers are bullshit. They have to be more diplomatic about what they think is going to happen and what they're arguing for. And I think it's a challenge. I think Mike Wirth has done a fantastic job, and we did this Chevron is Awesome podcast. So that doesn't absolve them of the ongoing huge responsibility and challenge of navigating these waters. But if anybody's doing it right, for my money, it's Chevron. And we'll see if they can continue. Yeah. And they're going to keep getting pushed. But for me, it comes back to, are you making money? Exxon would not be in this position if they had still had the return on invested capital and the excellent, they
have doubled the debt. They have
walk through every E&P
metric,
full cycle economics, break evens, et cetera. And when I started out in the business in energy finance, Exxon had the branding and the reputation as the excellent large cap capital allocator in the business. Similar to GE was the best managed company around. The narrative arc of both of those companies fairly similar. You go from being the 800-pound gorilla and an unassailable reputation to not.
Yes. Yeah. I mean, falling out of the Dow. I mean, they've lost a lot of COVID hit them really, really hard, and they were not well positioned for it. So I'm not defending, they are not they have not executed well. They were super exposed, and they're not a pure, you got to realize that these majors just came in pretty hard into shale only recently. So it's not like, we haven't heard the same things from EOG and Diamondback, this type of stuff, because these are smaller companies, more insulated without this sort of exposure. And they're also becoming free cash flow positive.
Yeah. As a digression, I should also mention, and this wasn't our agenda, so
That's fine.
I apologize that I'm ambushing it with you, but there was an important court ruling in the quote unquote Exxon new lawsuit where the judge basically, just they won. Exxon won. There was no, under the I think it's the Martin law in New York, which is a very stringent shareholder law. Basically, Exxon was not found to be guilty of any securities violation. So that was a nice little win for Exxon in a long-term campaign to prove that they knew about climate change, and they lied to investors about it, and that just didn't come to fruition.
Well, that's going to bring us to our. We're going to interweave and keep coming back, probably coming back and forth.
So you want to talk about executive orders?
I do, but not quite yet. Okay. So we're going to interweave this because that actually gets into. I'll just spoiler for the listeners coming up, but the climate change executive order was climate change financial risk, and that under Janet Yellen they are having basically a climate change individual or division. So we're in this administration is instituting climate change into the financial metrics of this country, which is very much game changing. And I do think if these measures had been in place for stuff like that, it's going to create precedent. And it's going to get things a little murkier and push these companies or push the investing.
So let me bring people on board with what we're talking about there. So 2 executive orders. In our last podcast, which for us was 30 minutes ago, but for you will be a week ago, Trisha talked about the slew of executive orders, which are 2x from the Biden administration, what they were under prior presidents. So executive order 14030 and 14207, and these are respectively climate-related financial risk, and then secondly, establishment of the Climate Change Support Office. So in brief, 14030 is a government-wide strategy for financing needs to get us to net zero by 2050. Mm-hmm. And then orders of various government agencies, National Economic Council, Office of Management Budget, Secretary Treasurer, basically to permeate climate policy into the government bureaucracy at every level, from lending to operations, et cetera. And then secondly, on 14207, the Climate Change Support Office basically is designed to aid the State Department, quote unquote, perform the specific project of supporting bilateral and multilateral engagement to advance the U.S. initiative to address the global climate crisis. So it's executive orders to push climate change through the public administration of the U.S. In fairness, it's exactly what they said in the campaign they would do. Mm-hmm. Right? I call that a campaign promise fulfilled. It is by executive order, not Congress, though.
Yes.
And
it's all in the back of the original executive order, all supporting the executive 14008, I believe, which was the one that was in the second week in office that was put into place, or the first weekend after one full week in office, that executive order. So all of this is sort of on the back of that. I will point out, just for kicks and giggles, you should browse the Federal Register and you can see all the stuff.
No one's going to do that.
And you should, because
Trisha will read the Federal Register so that you don't have to. That's why you should pay her to be your consultant.
Absolutely. That's 100%
because nobody's done that.
So, but the Federal Register, if you look at this, so it's important to note, because I had browsed it to basically reaffirm and see, am I crazy? Am I thinking how far are we pushing this? We'll get to this in DAPL in a second. Is the Biden administration sort of giving the oil and gas industry any kind of reprieve? And so I was looking at these executive orders, and Biden's actually, in the course of 2021, he has issued 46 executive orders. Donald Trump, in his first year in office in 2017, he issued 55 executive orders. So that's the whole year. So Biden is on course for in 5 months to issue. He's basically going to double what Trump did, and Trump did a lot. Barack Obama in 2009, in his full year in office, issued 38 executive orders. And in 2001, George W. Bush issued 54 executive orders. And you can remember George Bush, and I say this because this is not dissimilar. The more I've read these executive orders on climate change, the more it sounds to me a lot like what what had been done over the course of when we had 9/11 under this, unprecedented threat to America. And I think that's what climate change is basically being called an existential threat. It always comes back to the same language in the first executive order on climate change being this existential threat, and how we're dictating and how it gets into the foreign policy is something that comes up in these executive orders that does make me a little bit nervous, especially when it comes to LNG exports and things like that. But so executive climate change related financial risk, this was the May 20th, this executive order. It says the intensifying impacts of climate change present physical risks to assets, publicly traded securities, private investments, and companies, such as increased extreme weather risk, leading to supply chain disruptions. In addition, the global shift away from carbon-intensive energy sources and industrial processes presents transition risk to many companies, communities, and workers. So that's basically the premise of it. And then the section 2 of the risk strategy says the assistant of the president of economic policy and the director of the National Economic Council and the assistant president and the National Climate Advisor, in coordination with the Secretary of Treasury and the Director of the Office of Management and Budget, the OMB, shall within 120 days of the date of this order a comprehensive government-wide strategy regarding it's basically measuring the risk and assessment, the financing needs to achieving net zero, and it goes on, and you can get through the details. The point is that this is the administration using an executive order to get into the financial system. And I would...
And let me point out,
please,
net zero by 2050, which is exactly the IEA 2050 net zero report, which we have already discussed as being described as la la land.
Section 2
is literally the policy of this executive order.
Well, and to be fair, I mean, I'm sure Biden would say, well, that's the energy side, that's the oil minister of Saudi Arabia did say it's la la land, but it's Section 2, Part B, quote, financing needs associated with achieving net zero greenhouse gas emissions for the U.S. economy by no later than 2050, limiting global average temperature rise to 1.5 degrees Celsius, and adapting to the acute and chronic impacts of climate change. So the reason it is fair to bring up the IEA report again is because it's brought up a lot, and people are using these sort of references, and it's sort of this pushing, this foot on the throttle, is that probability factor, the 50% probability of achieving their 1.5 degree target within all the things that they were going to do to, immediately stop investing in fossil fuels. They have a 50% probability that they will actually achieve that target. So the president of the United States, this administration is now taking climate change and permeating it through executive orders, not through Congress, and permeating into the financial system. There will be ramifications for this. Like, I would be concerned if I don't care if it's climate change. I don't care what it is. I don't care if it's even something I thoroughly believe in. I don't really like executive orders messing with financial systems that much, because they tend to have repercussions. And it
also creates unnecessary volatility, because if we get a different administration, they can unwind executive orders, etc.
That's the other thing I noted reading the Federal Register was how many of the executive orders of a Trump he had repealed. Lots of things on the economy and things that's his prerogative. You can, but the next president, if it's not some super, again, another Democrat that's also pretty leftist.
And as an anti-federalist and an anti-big government conservative, I'd also like to point out that policy neutral, structurally, every quote unquote crisis, whether it's a real crisis like 9/11 terrorism or something else that may be a crisis in 2100, maybe, the response from the government is to grow the size of the administrative state.
Yes. Yeah. Well, so this gets back a little bit to like
centralized federal power.
Yes. And when I was reading all this stuff, I was just thinking back to like big government, small government. This is something that, this is going to draw party lines on, and not even just party lines. It's how people feel about certain, do you like big government? Do you like small government? This is very much big government. Biden is doing a great job in using climate change and COVID and stimulus and everything. This is big government. I mean, this is huge. We're looking at $6 trillion in spending. There's a reason why people are more concerned about.
This is the infrastructure bill proposal where childcare is infrastructure.
Which is part of why...
Not that childcare is bad, but...
No, but it's part of why people have us, the U.S., very more concerned about inflation in the U.S. than any part of the world, because we have a... we have a dovish monetary policy, and we have a fiscal side that's very big government, and they're using this opportunity to spend all this money, and that's what they believe in. I respect those beliefs. I disagree with. I'm very conservative when it comes to fiscal spending, and I don't like budget deficits.
I disrespect collectivist tyranny.
Somebody did last night on Bloomberg said something, which was it was a great quote, and somebody was explaining that the amount of money that we are going to have to spend, just for interest, paying off the interest of our deficit for everything we're spending for all the stimulus. It's so much in the future. We're just spending federal dollars, our taxpayer dollars, on spending off the interest of this because it's so big. So I don't necessarily think it's sustainable. It is interesting that how big these plans are, how big the proposals are in tandem with all these executive orders so quickly. It's either they don't think it's going to last, or they're trying to get it through, or they're just banking on getting wiped out in a year and a half.
From a political standpoint, this is not my wheelhouse, but I think there's some risk and fear that there is a change in the House in the midterm elections.
I'm guessing so, because I don't, and I'm not I'm not politically strategizing on this. It just seems from a business, from everything we're seeing, it's, if you're focusing on, I'm an expert on energy and I work on oil and gas, so I focus on this particularly. And I'm positive if you're focusing on different things, you may be seeing different things. But when it comes to energy, this is something that it's not going away. And climate change is very much at the focal point of this administration. So it impacts all this stuff. I want to bring back this to the executive order because it's also impacting federal lending and how the federal government is doing things based upon emissions. And Obama I remember when he was using our Export-Import Bank, and it was one of the first times we had he did not give a loan to India because they wanted a loan to buy equipment for Caterpillars and stuff, basically made in the US, but it was for mining coal. And so he did not approve that loan. It was the first time the federal government had really gotten involved in on environmental issues. It was a little, drops in the pool compared to what's happening now. So with this executive order, Section 5 talks about federal lending. So this is underwriting and procurement, and basically says that, blah, 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 Section B, the Federal Acquisition Regulatory Council, in consultation with the Chair Council of Environmental Quality and the heads of agencies, shall consider amending the Federal Acquisition Regulation, which is FAR, to require major federal suppliers to publicly disclose greenhouse gas emissions and climate-related financial risk and set climate-based reduction targets, and ensure, again, I'm quoting this, ensure that the major federal agency procurements minimize the risk of climate change, including requiring the social cost of greenhouse gas emissions to be considered in procurement decisions, and where appropriate and feasible, give preference bids to proposals from suppliers with a lower social cost of greenhouse gas emissions. I mean, there's so much stuff in here that's not defined, the social cost of greenhouse gas emissions. This kind of is rampant for corruption, I think, in many ways, of you can be a green company. What is the social cost of green? Exactly how are you going to define in one company over the other? Is that going to be this just seems very we're opening the door to, companies with, you have to be a very ESG centric company to then work with the federal government.
I can envision things like, let's say you want an SBA loan. Yeah. Are you carbon negative or positive? That's just one example.
But that
how
makes
this
me,
could
as a female run business, that makes me nervous that I have a company called PetroNerds. It's just that type of stuff of that. This gets from a business standpoint.
I prefer to think of PetroNerds as a high quality run business, regardless of gender, for the record.
Yes, but I'm just saying, there's a benefit to being female run sometimes. And then, this stuff makes you think that if you're in oil and gas, or you're not, have a lower social cost of greenhouse gas emissions as a supplier procurement, that's who they're going to favor. So, the incentive behind this is obviously that they want to push federal government contractors and suppliers to be green friendly and ESG compliant. I understand the purposes of that, but it's going to have trickle implications. And the requiring suppliers to disclose greenhouse gas emissions and climate related financial risks to set science-based reduction targets. we are barely at the point where we're requiring public companies we're barely at the point where we have really good clarity on public companies giving us full disclosure on their greenhouse gas emissions, on their CO2 emissions. So this is asking that all private companies, and I would say this will be a burden to companies that have to, hire people to then go figure out what their greenhouse gas emission intensity is and all this stuff to then be compliant with everything. And who knows how right that's going to be, how correct that's going to be. There's got to be people that'll fake that, and there'll be corruption and all kinds of things. But it's very interesting to me how fast this would proceed. And trust me, the government contracting space is huge. It's bananas right now with all the studies and everything that they're doing. They're hiring people left, right, and center, which is a good thing. I mean, hiring people is great, but the fact that we don't have a set standard for all publicly traded companies to have CO2 emission requirements, and yet for the federal government, you will have to have it, it's going to be extremely murky. And I mean, I remember when the stimulus package under Obama, if you talk to folks in North Dakota, and I've mentioned this on the podcast before, but I mean, when they were counting green jobs and they were counting jobs as part of stimulus, if a company, if like a store sold a pair of boots, they counted that as a job. If somebody put in a window, they counted that as a green job, I mean, so I wonder how these standards are going to be laid out. But that's true. Like, you can go up to North Dakota and ask, like, they put in a window, so it's energy efficiency, so it's technically counted. One, that's not a real long-term job, but that's semantics. So anyways, there's a lot more to this than I think people realize. And then it does also mention, it goes back and says, quote, as part of the agency climate action plans required by Section 211 of Executive Order 14008 on January 27th, which is tackling climate change crisis at home and abroad, and consistent with interim instructions for the climate change action plans issued by the federal officer. All this gets into this. It comes back to they get into flood risk and how they reinstated an order on flood risk. And then they do get back to doing this all on from a foreign policy perspective as well. And so all of it sort of folds in really neatly into that first executive order.
Okay. Well, let's go back to maybe one of the weird inconsistencies. And I'd like to recognize that a lot of this stuff, like Engine No.1 in the background, there's what's happening in the public, and then there's the inside baseball. So there are some narratives that we're just not privy to or not aware to. Same thing with, for example, the conversation between the Biden administration and the U.S. Army Corps of Engineers, which did not step up and say, shut it down.
Are you pivoting?
I was trying to catch off guard so I could get to it without you saying, don't do it. So
didn't work.
So where they basically refused to take a position. And I what's interesting to me about the U.S. Army Corps of Engineers and Dakota Access is, they said it was fine. They said, we're going to do the environmental assessment, which the environmental impact statement, which is more onerous than the environmental assessment that they did initially, which the court ordered. But a court came out and basically said, there's no clear and present danger to anybody of the pipeline continuing to operate, so you don't meet the threshold. I should also say, I want to say Energy Transfer statement, which is, we are pleased the court correctly recognized that the continued operation of the Dakota Access Pipeline presents no risk of harm to others and appropriately denied the efforts to shut down this vitally important pipeline. Disclosure, we own Energy Transfer in our midstream book, not specifically on this issue, but it didn't hurt. That stock has done pretty well year to date. And then, whether framed in terms of likelihood or imminence, plaintiffs have not made a successful showing of irreparable harm based on the threat of an oil spill at Lake Oahe, basically saying the pipeline's operating safely. It doesn't look like there's any problem that's imminent. So that was a big issue. And
yeah, so no, I had put out the thesis, and Ethan is pushing me to pivot, which we're gonna circle back to this Exxon thing. So Paul Teese, who's this adjunct professor at the Stern School of Business at NYU, spoke at the Energy Policy Research Foundation and the Global Gas Center's Forum webinar this morning. And, he linked these things together, actually, DAPL and the Exxon thing. And his stance of analyzing this from an investment standpoint was really the same way I sort of look at this, really. And I mean this truthfully, when I'm looking at these executive orders, it is not so much of, I don't agree with this, which many of them I don't agree, but it's really, what is the risk? How do companies, whether you're green or otherwise, or oil company, how do you have to perceive this risk? And so his actually point on this was that he he didn't think it was positive from the administration on DAPL. He thought that, by the time, or he was open to the concept that, when March rolls around, the Army Corps of Engineers could extend this pipeline. Now,
meaning they're going to have a positive EIS and DAPL was going to keep flowing.
No, he was saying that
he's saying they think it couldn't.
Yeah, he was saying that they could access now. So
it could happen.
I want to rewind because I will be happily to say that I'm wrong in terms of Boasberg basically had his hands tied, but he actually wrote this awesome little document that is really, really good. If you want to know the history of the Dakota Access Pipeline and everything, Boasberg this was filed on 5/21/21, and it's a 31-page document. And basically, Judge Boasberg is explaining very clearly how this went about, and he's kind of like joking a little bit in it too, with his candor. And I am going to read this quote because you need to understand that they lost. So he basically had his hands tied because the Army Corps of Engineers didn't do anything. So it wasn't the Army Corps of Engineers camp to basically make a decision. They punted on it, and therefore Boasberg couldn't do anything because the tribes did not give him enough. So the Standing Rock Sioux tribe and the Cheyenne River Sioux tribe did not give enough evidence to explain that the pipeline had to be emptied. So basically, they won the initial battle of saying, you should have had an environmental impact statement. You didn't have an environmental impact statement, so you're encroaching on federal land. But then after that, then the higher court slapped Boasberg's hands, which he explains, and then he basically had to have enough evidence to say, hey, it's doing irreparable harm. You're doing more damage by letting it run than you would if you emptied it. And they didn't show that. He couldn't decide on that. So it's kind of interesting how that went down. So I in a way, I do think it's in the Army Corps of Engineers' hands. There's a couple reasons why they could be punting on this. And one of them may be, Colonial Pipeline and the fact that oil prices are going up. And this administration does not want to be blamed for killing an infrastructure project that's already built, taking it out of service and jacking up oil prices, which would happen.
Yeah, and let me just interject here. I've seen some crazy stuff out there from the far right, which I want to disabuse. Number one, Biden is not responsible for accelerating natural gas prices. That is a function of the economic recovery and basic supply and demand. It would have happened regardless of who the president is. Now, 2-3 years from now, when the impact of these policies rolls through and we have more restricted supply, that might be different. But let's also say that Biden might be on a global macro level, better for gasoline prices than the Trump administration would be because of Iran positioning, because Iran supply is more likely under the Biden administration than would have been under a Trump administration. So I want to disabuse people of that. The second crazy thing I've heard is that somehow the shutdown of Colonial was a conspiracy theory, and that this savvy pipeline company would never have been in a position to have a simple cyber attack like this work, and that it was just some conspiracy to raise gasoline prices or profit in the short term. That's nuts. And I'll tell you, these companies are not ultra sophisticated cybersecurity experts. They're just businesses that are operating on technology that's been around 100 years. And I don't see anything suspicious. And we know a lot of people in the industry and credible people in this business. There is no justification for this idea that there was some sort of conspiracy on Colonial Pipeline. Now, if there is a conspiracy, it's on the one hand, it's the conspiracy is wide open, which is Keystone XL. You've shut this down, and guess what? You could have an administration come back in and allow Keystone XL in the next administration. So on the one hand, you've got, regional governments preventing, state governments in the Northeast preventing pipelines in the Northeast, which is where we need new gas supply. That's not happening. We have Keystone XL, which is a big, low probability, not a Canadian government priority, that was shut down. We have Colonial, the downtime of which was very problematic because people still need gasoline, surprise. And the Biden administration put out a lesser hyped release about more cybersecurity around pipelines. And then finally, the Canadians do have as a primary Line 5, which takes oil into Michigan. and the governor there is fighting with the Canadian government about Line 5. So
Line 5
yeah.
Well, Line 5 is actually, that's the longest winded thing. One, I let Ethan talk for one.
Longest winded. Who are you?
Yeah, just like look, he talked for a long time. A nice rant.
Oh my gosh,
Ethan. That was good. I am interrupted. So Line 5 is predominantly a propane and it's a dual pipeline. So it is oil, propane, and NGL. So all those are. We'll come back to. I don't like conspiracy theories either. I think right after we'd recorded one of the podcasts, I think Ethan turned on a conservative news station, and I don't mind here. I like learning all kinds of things, but the way they were talking about Colonial Pipeline was absolutely incorrect. And they were just missing lots of bits of information. So
apologies to people who watch Fox all the time, but Fox is like the right-wing version of CNN. And when they talk about energy, it's just like,
what's the problem is energy, and that's why hopefully some people listen to this podcast that actually want to understand energy. So I do apologize for getting too much into the politics, but it is a piece of it's a piece of this.
I don't apologize. It's important. It's
a piece of reality. So all these administrative stuff. Well, okay, I want to come back to the actual what Boasberg said, because I don't think a lot of people truly understand what happened with the pipeline. So, by the way, it's been running 570,000 barrels per day. They're increasing this. They're already working on increasing. So they're increasing the pump stations. This pipeline is getting expanded. So on the face of it right now, it reads very well for North Dakota. It reads North Dakota's private land. There's smaller companies. I mean, and North Dakota was doing well in terms of folks wanting the assets, and trying to get in over the past 2 years. But I think now, especially if there's a green light on Dakota Access, it's extremely positive for Wilson Basin production. So all of those who are a little bit negative on Wilson Basin, on the Bakken, on the Rock, and the longevity, I'm here to tell you that I think it has more running room left. And if you listen to the folks out of North Dakota, they will tell you the same thing. But all that being said, so the pipeline, the actual ruling, so Boasberg explains really well that he says that so just like the Dakota Access pipeline, quote, which meanders over hill and dale before carrying its crude oil underneath Lake Ojai, a large reservoir on the Missouri River between North and South Dakota, the current litigation has wound its way through a myriad of twists and turns. This is literally how he writes this report, which
is lovely.
Yeah, it actually was quite lovely. It's entertaining too. So last year, in a hard-earned victory for the American Indian tribe plaintiffs, whose reservations lie nearby, this court found that defendant U.S. Army Corps of Engineers had violated federal law by failing to produce an environmental impact statement before granting defendant intervenor Dakota Access LLP an easement to run the pipeline under Lake Ojai. The court subsequently vacated that easement and ordered the pipeline emptied of all oil until the court could complete the federally mandated EIS. Wasting no time, both Dakota Access and the government promptly appealed to the DC Circuit. In a partial win for the tribes, the Court of Appeals affirmed two central elements of this court's rulings, specifically that the Corps should have prepared an EIS and that the easement was properly vacated in the interim. The circuit thus confirmed that the pipeline was, in legal speak, an unlawful encroachment on federal land. And then this is really where the answer comes in. And this is the one page of 31. Quote, it was there, however, that the tribes ran out of luck. Prior to the cessation of oil flow, the circuit stayed and eventually reserved the aspect of this court's order shutting down the pipeline, reasoning that it had not made necessary findings for what was essentially injunctive relief. In other words, although the vacatur, and I'm hoping I'm saying that right, the vacatur of the easement rendered the pipeline an encroachment on federal property, vacatur could not itself bring about the stoppage of oil. For that to occur, the Court of Appeals clarified this court needed to conduct an additional, distinct inquiry, a component of which requires the tribes to demonstrate that, among other things, they will likely suffer irreparable harm in the absence of an order closing the pipeline. End quote. That basically says everything you need to know. And he talks about all the, all the media attention this has gotten, but I mean, it's explaining very clearly, he made this order, he got his hand slapped, it got reviewed, but they had to basically prove that, they would have irreparable harm, and the tribes didn't prove that. And he obviously, I think, was kind of saddened by that, but they didn't prove it, because it is such a tiny piece of this. And it's not to say, that I'm not dismissing their claims and everything either, but
Now, talk about Pyrrhic victories. So, number one, you have to give the Earth Justice attorneys credit where credit is due, because they absolutely kicked ass, and they cost Energy Transfer and industry and the pro-oil interests aligned here, including Phillips 66, which is one of the minority interests in the pipeline, millions and millions and millions of dollars, both in the delayed start, as well as attorney fees, et cetera, and cost of capital impacts, right? So that's the first thing. The second thing is they're still not completely out of the woods, because there still is uncertainty about whether the EIS will be approved. I put me in the camp of if I hate it when people won't give you a probability number. So my gut, based on just how this has played out and how the Army Corps has treated it so far, is that 85-90% sure the EIS will green light, based on the exact same math and history of what the Army Corps has done before, will green light the pipeline. So that's not 100% probability, but it certainly is better than being shut down in the interim.
Well, and that's the things that is really specified in this report is the Corps punting on this whole thing. The Army Corps of Engineers did not, basically it was in their hands to make a decision on this.
Well, so my take on this is that they are professionals. They are working in the realm of science and engineering and rules and regulations, and they don't want anybody, left or right, messing in their business. And they are probably doing what is the most prudent that they can, which is being as hands-off as possible. What they, I think, would argue, if they could all stand up and say, is we're engineers. It's our job to assess this risk. The pipeline is very safe. This has been politicized and turned into something about Native American rights. A lot of these issues are very legitimate, about treaties and who owns what land and what should be done in consultation. But our focus is on science and engineering and environmental risk. We looked at it. It's fine.
Right. And that's the whole premise of it. They gave the Army Corps of Engineers did the environmental assessment, the EA, and determined that they didn't need to do the environmental impact statement. Now, what got overturned was the NEPA, which is the National
Environmental Policy Act.
Environmental Policy Act, thank you. That basically under that, they needed to do the EIS. So basically that's where the Army Corps is like, okay, we're doing the EIS. So, could, in theory, the administration weigh in? Absolutely. I think if they really wanted to, they could probably win. So we will actually see, come March. But right now, it looks as though they're going to do this. And in theory, it looks like it's going to be fine. But hey, last June, in theory, we didn't think, we were going to get a ruling necessarily to empty the pipeline. So, it's not over till it's over. But I'll just say that, he does point out that, he quotes the Corps additionally maintained without citing any authority that it was under no obligation, quote, and he's quoting this, to take any particular action to cure an encroachment within a specified time period, or even, quote, to eventually cure the encroachment all. So, he kind of gets at the Corps for not having a really good defense, but still defending themselves. And, the one hearing that I was able to actually listen to the whole thing was fascinating, because he was like hard on the Corps, and the Corps was like, using every legal wrangled way to say something without saying anything at all. They were trying to wiggle out of it. So they're in a tough position. But basically this became Boasberg favoring the tribes, making his ruling, and the Corps sort of not doing anything, makes it not doing anything. And then, this all favoring DAPL. And in the reality, from just a technical oil and gas standpoint, this would have pretty damning impacts. You would have immediate economic and impacts to emptying this crude oil pipeline. And now you're going to expand it. So, I mean, we could be emptying it when it's expanded. So if this is...
And the net is we should bring it back to the big picture, which is very good for Bakken E&Ps.
Really good for Bakken E&Ps.
Marathon.
Right. And into
Continental Resources.
In the context of this and all...
Which we own, by the way.
All these private companies, by the way, all these private companies that are extremely well. If you're a private company in the Bakken, you should be. I mean, it looks great for you. I mean, if you're a private company in the Permian, it looks great. If the sage grouse stuff, which sounds like sage grouse is now a new topic, which we will get into probably in the next podcast. Topic. It's a new old topic, but I think the Biden administration is bringing it back to be a potential issue. That could make things messy in the Permian, but in terms of that also makes North Dakota, things that go bad in the Permian often make North Dakota a little more favorable, and people forget that this rock
and vice versa.
Yeah, and vice versa. But people forget that this, it's far from refineries and it has pipeline issues, but this pipeline doesn't get empty, and if it gets expanded, you have a pipeline. This could be 700,000 barrels a day crude, that's going from North Dakota all the way to the Gulf Coast without having any, bottlenecks and getting Brent pricing. That's pretty awesome. That's big for these Bakken producers. And so if you're private in the Bakken, or if you're a small public company, I think the stuff that happened with Exxon should make you consider, like, can we go private? What would it take to go private? Because if you're private on private land, you're in a much better situation than your peers.
Well, absolutely. If you think about the shrinkage of, so why do companies go public? It's increased liquidity and better valuation. That is in a nutshell. There's a lot of reasons, but those are the main reasons. If you no longer have big asset managers willing to buy your stocks, and I don't necessarily think that's the case, because I ultimately think the move towards free cash flow, both in midstream and upstream, is going to invite a lot of capital in that doesn't care about ESG and just cares about making money.
But it's bifurcated then. This is bifurcated
it is
capital.
bifurcated. But let's assume that the big public money goes away. That takes away part of that element, and you're left, sure, you want more liquidity, but at some point it starts to become such a huge hassle to meet these metrics and basically be an ESG diplomat, when what you really want to do is focus on producing as much oil as you can at the best margin possible. The benefits of being public are not quite what they once were when, these things didn't matter or they weren't prevalent.
Absolutely. And, though I also want to quote Dan Pickering and Chuck Yates for a couple weeks ago in the previous podcast, is that nothing is certain, right? Like, we think about this standpoint now. Like, if you think this is what the environment's going to be like 2 years from now, you're probably wrong. I think we're feeling these major changes, these monumental shifts within, and if you just listen to the commercials on Bloomberg, that the ESG movement and how the train has left the station and, we can't get away from it. Yes, that's all happening right now. That's really real. But is it always going to be exactly like this? I don't necessarily think, I'm not certain of that, because, if this stuff doesn't work out the way all these folks, investors, activists, and everybody want it to, and ESG emissions, and CO2 emissions don't actually go down, and warming goes up, and we're demanding more crude oil. We're going to be at 100 million barrels a day at the end of the year. So for all the we're talking about, nothing's changing from a demand standpoint. And, all that's changing on a supply standpoint is the Saudis keeping their barrels off a little bit and letting oil prices go higher so they can market their stuff. So
and don't sleep on $3 summer natural gas either in the US.
So technically what is changing, other than we're all wrapped up in this craziness in Europe and in the US and in the stock market? Like, I'm just not certain that, the market's going to look exactly like this, because the momentum has shifted. I also think that that bifurcation you explained really well is that, a publicly traded company, this is why I question the role of this activism of, unless you're going to increase the share price performance and the dividend, what does it matter? Stand on your head, spin a top, do whatever it takes to do that. But if it doesn't actually increase the share price performance, it doesn't mean much, right? So in order for those investors to get their money back, or a point, that's the impetus of the pension holders, or maybe it's not. Maybe they just care about this, like people, writing GameStop. It's something that they believe in, and that could be the case. That's what they're doing. It's a free country; no one can technically stop them. But there's stuff behind it, like maybe Engine No.1 starting this green fund and getting the publicity, and and writing this whole thing. Which kudos to them, they actually did it. But the flip side could happen too, which is already happening, in that people are looking at oil and realizing, okay, it's not super sexy. We don't love it, but oh my gosh, is it going to make money for the next couple of years? Like, it could make money for the next couple of years. And, like you said, these companies are.
My personal metric is when a former colleague of mine, who is a New York liberal institutional broker, wants to talk to me about what's the highest beta private equity oil and gas investment he can make. I think we're back.
And what did you tell him?
Well, I told him we'd be happy to talk about a separately managed account on a long, short basis with some aggressive options for him. Of course.
You didn't say the PetroNerds would be consulting on that as well?
Sure, I'm sure. Well, yeah. We can add that to the mix.
Awesome.
So, dare I ask if this is if you've purged all your oil and gas demons?
I feel like
now.
I have. I hope our listeners, this has done these topics justice. If it has not, or you have questions, or you want to, tell us to push stuff in, we're happy to these are topics that are not going away anytime soon. But I will leave our listeners
Trisha at PetroNerds.com, Bellamy at BPCfunds.com. We'd love to hear from you and get our feedback.
Thank you guys so much for listening. Really appreciate it. I don't know if we said at the beginning, this is still Thursday, June 3rd, 2021. And we will be back next week or the week after.
Yeah, I might have to do a podcast episode specifically on the government's forthcoming UFO report.
Oh, we also have to mention before closing, if you're still listening, Digital Wildcatters is hosting their Energy Tech event on June 23rd. It's going to be awesome. It's in Houston. That's in the evening. Reach out to them for tickets. If you do not have a job, they are willing to give you tickets as well. And if you cannot afford it, for free.
Ticket.
So that's awesome. Going to be an awesome networking event. I'm
Texas.
Sure. Houston, Texas. So reach out to them for that. And then I am going to attend the Liberty Oilfield Services Investor Day on June 17th. I'm super stoked about that. So very, very pumped. So we
love Chris Wright.
Yeah. And we'll definitely be talking frack and all that stuff. So that is forthcoming. And thank you all so much for listening.
Thanks, y'all.
Bye.